Welcome to episode 2 of our series, Finance for Startup Founders. In the last episode, we talked about rates, required rates, and interest rates. So, a couple of queries were when do we use the term interest rate and what do we use the term required rate? Usually, we use the term interest rate when we're talking about debt instruments, like it could be a loan, it could be a fixed deposit, it could be a bond, that we use the term interest rate. The term required rate is used when you're talking about equity markets or mutual fund. Mathematically, they are the same. It's just used in two different conventions based on the circumstances. In today's episode, we're going to talk about time value of money and how do we use it in finance. We're going to talk about compounding. We're going to talk about discounting, present values, future values, perpetuity, and annuity. The session is a bit technical. This is not an academic finance course, so we'll not go into the derivations or the theory behind it. We'll see how it is applied in practice. We'll also deal with a bit of Excel also. Now, if you look at the screen, let's consider doing something as simple as a fixed deposit. Let's say you are doing a fixed deposit of 1 lakh. The bank is offering you an interest rate of 6% and you're keeping the money invested for a period of 5 years. And at maturity, what you get is an amount of 1,33,000. This is one of the most simplest of calculations. Let's take a look at the formula that we have used in this calculation. In Excel we have used the FV formula. FV stands for future value. The first input is the rate the bank is offering. Second is N per. N per is the number of installments. It could be years in some cases, it could be months in some cases, based on what circumstance we're handling. Third is PMT. We'll leave it for the time being. And the next term is PV. PV stands for present value. In our case, the amount that we are investing right now. You can see a negative sign in front of the number. The convention is when the money is flowing out of our hands, we use a negative sign, and when we are receiving the money, we use a positive sign. So we use the future value formula to calculate the maturity amount of this investment. This is not any different than the mathematical formula that we probably used in high school and high secondary. I mean, principal into 1 plus r raised to n. It's the same thing. Excel uses there's a built-in formula in Excel called FV. Now, why we use this in this demonstration is, in many times when you are dealing with a financial entity, it is likely that they will use this formula, not the pure mathematical version. So now that you're familiar with it, imagine the same calculation. Instead of a lump sum amount of 1 lakh, you're doing the same 1 lakh as a recurring deposit over 5 years. That is in 60 months. So for the amount, I have divided it by 60 months so that you know your monthly payment. Rate is same, the number of years is same. Just that I've expressed it in number of months. Instead of 5, I've done 5 into 12 equal to 60. And since we are doing a monthly payment, I have converted the annual rate into a monthly rate, basically 61 by 12. And if we use the same future value calculation for this, we'll get a slightly lesser figure, obviously, because we are locking in money for a shorter period of time. We'll get 1.66. But this difference to note is the formula that we use. It's the same future value formula, same rate, same N per. Note that rate is 0.5 per month and NPR is 60 per month. And in the last formula, we left this PMT blank and we use PV. Here we are leaving the PMT populated and the PV blank. The idea is when you are doing a lump sum payment, use the PV, and when you're doing it in installments, use the PMT option. Here also we use the same convention of negative sign. So we can see the difference of two use of the same formula. Now the same 1.33 I have indicated it across different years. In finance, when we talk about the current year, we use the convention time period as 0. This is very similar to what we use in arrays in programming. First index is referred to as 0 and subsequent years are shown as 1, 2, 3, 4, 5. So here the first year, the current year is T0. The 5 years for which we are investing is shown as 1, 2, 3, 4, 5, and this is the maturity amount. So this approach is used for future value. If I make the investment today, what's at a certain rate, how much do I expect to get back after a number of periods? Now let's think about the reverse case. Invest instead of converting today's value into a future date, let's do the reverse where we calculate a future value to today's rate. That is what we use in the PV functions, present value functions. Let's say somebody promises you a payment of 1,50,000 in, let's say, the same 5 years. To get this, how much payment should you make today? Let's say you made a payment of 1 lakh today for the same thing. In this case, if you make this investment, you're getting a return of 8.45%. We are using a rate function here. In rate, the first one is NPR, the same as last year, a number of years. Payment is there is no monthly payment. Present value is what you're investing now. Future value is what you're getting. Under these circumstances, you will get, and under these numbers, you're getting a returns of 8.45. In the last example, we used a return rate of 6% and we got 1.33. And in this example, at a return of 8.45, we're getting 1.5. Now, instead of somebody promising you something, let's say you have a need which will arise in the future. You have to buy a car or some fixed targets. Let's do the same thing. It's the same 1,50,000, same 5 years. I'm just using the same number so that you can appreciate the difference. And if the interest rate that is offered by your bank is, let's look at the same 6% as earlier, and to achieve this target, you would need a payment of 1.12 lakh as of today. Everything that we said now is very applicable to personal finance, but later in the session you'll understand that how investors consider their investment in your startup is not different than this. I mean, it's the same underlying mechanism. Only thing is the number of variables are slightly more. Let's consider a last case. It's called a perpetuity. Perpetuity is a situation where you are offered a perpetual payment. Perpetual as a non-stopping. You are assured of a payment at a fixed frequency for the rest of the time, forever, to be speaking. Now let's say, consider a retirement plan. You're 60, you just retired from your job, and you're making some investment so that you'll get a monthly pension for the rest of your life. Let's say you're considering a plan which is offering you a monthly pension of 10,000 rupees every month. Let's keep it simple. So if you are given 10,000 in a year, you're making 1.2 lakhs. The rate in the market right now is, let's say, 6%. To buy such a policy, you need to invest 20 lakh as of now. Or in other words, if you invest 20 lakh as of today, you would receive a monthly pension of 10,000 for the rest of your life. Theoretically, even after your life, I mean, forever. So your next of kin might continue to get it. The practical problem here is we did not account for inflation. I mean, 10,000 today is not 10,000 5 years later. So you need a scheme where you have a growing return. You're getting 10,000 per month this year. Next year you might need 11,000. The year after you need 12,000. So you need some sort of increment year after year. Let's say you need an increment of 4% per year. So let's consider that case where you're starting with 10K, but you're getting a 4% increase every year. To purchase the same policy, instead of 20,000 as an earlier example, 20 lakh as an earlier example, now you will have to make a payment of 60 lakh initially. So why I show this example, I mean, a constant number versus a growth number, this is very important concept when we come to DCF valuation on a future date. because companies are supposed to be perpetual. Companies is not for a short period of time. They continue to exist into future, and their growth and cash flows are supposed to increase over it. So when we do valuation on a later date, we will use the second method, which is the growing payment method. Just keep this next point in mind. We'll not discuss much about it. Here in our example, we talked about a pension. Now, when you're doing valuation of the company, the equivalent term would be FCF, free cash flow. Instead of you receiving a pension, the company will generate funds which can be used for multiple purposes, different purposes. Instead of rate, we use a concept called WACC, weighted average cost of capital. And here we were calculating how much should I invest now. In corporate, in a valuation situation, that final number will be called the valuation of the company. We'll talk about the details later. Now, annuity is very similar to perpetuity. Only thing is it does not extend forever into the future. It is done for a certain predetermined number of years, 5 years or 10 years, etc. So I've calculated the same example. Instead of a perpetuity, if it's a 10-year time period, instead of 20 lakh, you'll have to make a payment of 8.83 lakh only to buy this package. Now, just for demonstration, I have done some calculations of valuations for the same amount, for the same rate, and different periods of time. So it's the same number, 8.3. If you need it for 10 years, the present value is 8.83 lakh, so and so and so. And if you need it for 100 years, which is pretty much a perpetuity, you would be paying 19.94 lakh, and you can see the number is not so different. So I believe I have given you a quick understanding of what future value, present value, perpetuity, and annuity is, and it's the same concept that we're going to extend when we talk about discounted valuation on a later date. This is applicable for your personal finances as well to some extent. Now, before we wind up, some people are asking me which books I'm using or which books I'm referring for this discussions. I use a couple of books based on which topic we are discussing. One of when it comes to accounting, I refer to Cost Accounting by Libby and Hodge. There is an amazing book called Accounting Simplified by Professor Rajapashate. He is from IIM Kozhikode, and it's an amazing book to read. It's much simpler compared to the other books that I've read. When it comes to valuations and future values of money, I used a book called Principles of Managerial Finance by Lawrence J. Gitman. I also use Corporate Finance by Ross and Westerfield. I also refer to the valuation notes referred by written by Damodaran. So I hope this helped. Follow for more information.